What's up traders, Tom here with another video. Today we will be talking about when to take risks and when to take some rewards. As everyone tries to figure out what fair price of the stock market is, why aren't we discussing the true dilemma? Stay tuned. Firstly, I would just like to say a big thank you to everyone in the trading community posting their comments yesterday about their top 3 stock picks if a second crash was to occur. It's great to have a plan so you can instigate it. If you agree with the policy of no FOMO when it comes to investments, then you should subscribe and hit that bell for more content covering the financial markets. So in this video, we'll be covering the bear and the bull side for the current stock market price and over the next 12 months. We'll try to keep it a little bit in the middle, but at the same time, my opinion is still relatively bearish, and that is because of value versus risk. And we'll talk about that more over the video. So let's begin with Boeing. They've now cut more than 12,000 US jobs and thousands more are planned. We also have downgrades through multiple companies, including a big one. Disney has been downgraded to underperform at Imperial on concerns about the theme parks, film businesses, and everything else. No surprise on Disney, but worth noting. But how about this news? Our man Carl has sold his stake in one of his favorite companies that he's been telling everybody to buy for multiple years. And he sold them at 72 cents on average, netting potentially around a $1.88 billion loss. What really annoys me about this though is what he said afterwards. And I'll just literally draw an arrow to it. He added in his statement, "I believe that based on the plan of reorganization that includes new capital, Hertz will again become a great company." If it's going to be such a great company, why is he selling every single stock that he has in this share? And I think that whenever he says something in the future, people need to definitely think about it twice, because as I said in his portfolio review, he has not been picking some good stocks recently, and we need to remember that he bought more Hertz in March. So interesting, he's taken a loss. But it's lucky for shareholders that Hertz has actually recovered a little bit since then, and it traded as a close yesterday at $1.31. So, at least the shareholders that are still holding it have the chance of potentially getting a better price than Carl. So the proponents for the stock market crash, well, I say there's some big names in it, but as we saw with Carl before, what somebody says and what someone's doing often can be very different. So we have people like Mark Cuban, David Tepper, Stanley Druckenmiller, and they've all warned about the overvaluation of the current stock market. We also have Paul Tudor Jones and others warning about a double bottom, and they believe there will be a second pullback in the market. Now, do they still hold stocks long? Absolutely. And as everybody knows that's been watching my videos, I'm a proponent long-term to hold stocks and hold quality. And I think that it's a time now where you should consider holding quality companies and picking your specific stocks more than just trading indices. There are reasons for that, and we'll cover them in future videos. So the S&P 500 has crossed 3,000. That is a key psychological barrier, and it will be interesting to see whether it can hold it for the week. In terms of technical analysis, we are above the 200-day moving average, and we have closed in the real market above that zone. So I really think we'd need to see weakness in the next 2 trading days for the bears to get back in control of this market. Otherwise, the bulls may have their way with the bears next week, that's for sure. So we've talked a lot about the negatives, but let's talk about some positives so we can build a story here for both sides. So Bank of America's head of global research has said that they see S&P 500 rising 14% over the next 12 months. So they think it's a no-brainer in terms of stocks relative to bonds. I don't disagree in terms many bonds do not present good value right now, and I can see why you would be buying stocks over bonds at this stage. But what about the valuation of the S&P 500? Well, FactSet reported on May 22nd, the forward 12-month PE ratio for the S&P 500 is currently 21. This is actually above the 5-year and 10-year averages. And when we talk about the 5-year and 10-year averages, we have the 5-year average is 16.8 and the 10-year average is 15.1. So pretty different numbers in terms of 21 is definitely way higher. And that's because of the amount of tech stocks in there, but also because of things like quantitative easing. When it comes to quantitative easing, it's really difficult to see how it interacts with share prices. I think it's kind of proven to a degree that it raises the overall valuations of shares over the long term. If we have a look here, this is the combined assets of the Fed, Bank of Japan, and the ECB in terms of trillions versus the entire world index. And we could see the tracking of both of them together since the GFC over here. Now, this figure doesn't include the most current Fed, Bank of Japan, or ECB stimulus, but it is interesting to see how it tracks. Now, if this was to continue, and we know absolutely that the combined assets of the Fed, Bank of Japan, and ECB is probably more like this right now, it's a fairly long-term bullish case that the stock markets will try to catch up with that stimulus as it gets pumped through the system. So it's very interesting and definitely one to watch. And I'll be covering more of this kind of idea on the channel. So make sure to subscribe and hit that bell for more information about that. Another reason for the bull side is that companies have just reported their earnings, and 95% of them have now done it. I think it's more like 98%, and around 64% of those companies have reported positive EPS surprise. So they are generally reporting relatively well against expectations. So the expectations were a decline in earnings of 14.6% and growth in revenues of 0.8%. Analysts overall expect earnings decline of 20.8% and a revenue decline of 3.9%. So effectively, for the year of 2020, they're writing it off already to a degree. Now, for anybody that's looking at the next earnings in quarter two and thinking, oh, they're going to be terrible, the stock market already does think they are going to be bad. So for stocks to decrease off that news alone, you are going to need to see them at least come in around that expectation, because the stock market's usually a little bit more positive than that kind of negative earning. Or if they come in under it, absolutely, we will see huge amount of bearish sentiment come back into the markets unless the Fed support it. So we have many negative quarters ahead, followed by a quick return, it looks like, to revenue growth in terms of the expectation. So for anyone that hasn't been trading the stock market for a long period of time, think of the stock market as always thinking 12 to 24 months ahead of whatever's happening. The reason we saw such a massive crash coming off this current crisis was because the stock market was predicting not only an instant GFC, but on top of that, they were predicting multi-years worth of struggling growth. Then you have the Fed coming in, saving the day, and of course, all of the different economic policies around the world. And that's what's led to this pretty big bull run off the bear crash. So if I was looking at the bull side, well, where is the value currently? This actually has a target rating. So they believe that there's a 9% increase over the next 12 months, that real estate, financials potentially have the best value in them, and that things like technology and energy have very little value in them anymore. And that's why we're seeing that rotation a little bit out of the Nasdaq and into other sectors. So if you're a bull case and you want to buy things, potentially looking at other sectors could be the best solution for you. But this brings me to the risk reward standpoint. If the down case is, let's say, 30+%, and the best up case is only 10% or less, because most people think over the next 12 months, really, it's only going to get to around the price it is currently, then is it worth putting your money in right now, or is it worth waiting on the sidelines and potentially finding companies in the future, if you miss out, that could present good value? Well, I think this is the problem, and this is what I always think of when it comes to value versus risk. Would I rather have my money in a stock that I have 100% conviction in, or would I rather have my money in a market that I'm constantly checking every single day and scared to death to be in because I think it's going to drop off at any moment? You've got to think about your psychology coming into the investments. If you buy Microsoft and you go, I love Microsoft, I could not even look at the stock market, kind of like Warren Buffett says, if the stock market closed for 2 years, he wouldn't care because he believes in his companies. If you don't have that kind of conviction, then you probably shouldn't be looking at certain stocks. So I think from the bear side, it really comes down to, do you want to take the risk? And if you want to take the risk, then it may be worthwhile in the long term to potentially get into the market. But for me, I think the risk is not worth the reward. And if I was only going to be making potentially 5 or 6%, and I was worried about being in a stock market like it is right now, I'd rather just sit there and earn and compound my money somewhere else. And that is, I think, the biggest problem. For the bulls, I think the strongest case is it is election year, and Trump really loves talking about the stock market, and he gives a lot of validity to the stock market doing well. I think yesterday he literally tweeted Dow above 25,000, S&P above 3,000. It's great. So he really does drive a lot of the stock market policies in terms of he really wants these policies to remain. He wants everybody to keep going on, especially coming into the election. From the technical side of things today, well, we're pre-market open. It looks like we are trading at around 3,047. We'll soon see, I believe, the unemployment figure numbers. I might put them at the end of this video. But basically, we are above the 200, and the next point of resistance really is around this 31 kind of 20 zone, 3,100. I think the more interesting technical analysis really comes when you look at the dollar index. So the US dollar has been trading within a range, and that range has been pretty steady now for pretty much most of April into May. The support here at 98.60 is holding. And if it continues to hold and we see a bit of dollar strength, generally US dollar bullish sentiment at the moment has been led by bearish market. And that's because people are pulling money out of the market with a risk off approach. So I'd be watching this support line, and I'd be paying some attention to it for sure to see how everybody's thinking about it. It could give us future insights. Quick reminder for anybody that doesn't know, you must have an economic calendar right now if you're looking at trading or investing in the markets, and you must be aware of the time that certain information comes out. So here we have the unemployment claims, and we can click the button here, and we can see the unemployment claims, what's happened, and really this, since the crisis has broken out, how extreme these numbers have been when compared to forecast. And if we actually zoom this out, you can zoom out all the way to multi-years, go back and look at the GFC, etc. So I'd like to just leave everybody with this thought when it comes to investing in the market. If you think that you'll be looking at the price ticker on your shares or the price ticker on your investments every single day, and you'll be worried about them and you'll have too much money to sleep at night, then you generally should really think about your plan and strategy. Investing shouldn't be about having a heart attack every day. It should be about making an investment in your future and to have an absolute conviction and belief in what you're doing. So if you enjoyed this video today, please remember to smash that like button, comment down below and let us know what you think of this channel and how we're going so far, and give us any feedback. And of course, hit that subscribe and alert button, and we'll see you in the next video. Happy trading, everybody. See ya.